right, welcome everybody. Um, this is another one of our educational sessions. We're going to be looking at options again today, and we're going to be looking at how to lock in profit when the options market is closed. And a little bit of a spoiler alert: what we're going to be looking at it technically is called Delta Hedging, but we'll get into the specifics of everything, of course, in a little bit. First, we need to go through our disclaimer as always. Where'd my other thing go? Oops. That's what I'm looking for. Okay, everything we do here is for educational purposes only. We are not investment advisors and do not provide investment advice. All statements made here are my own personal opinions and not recommendations to buy or sell any security. And all trading and investment decisions are your own and done at your own risk. Okay, I think everybody here knows who I am, but if you don't, this is me. I'm Kevin D in the Discord. I've been trading for a very long time. CMT level 2 candidate, born and raised in Vancouver, still here. Yeah, so that's who I am. Let's move on, take a look at what we're going to be getting into today. So we're going to be learning how to lock in profit even when the options market is closed. So if the after hours or pre-market trading is available in equities, we can go in there to lock in profit on any puts or calls that we have that are in play. So we'll start with a really quick review. We're going to look at what is a put and what is a call, just really quick. I'm sure you guys already know, but we'll just blast that through that to make sure. We'll look at Delta because this is critical to what we're doing, because what we're doing is Delta hedging. So we really have to have a good understanding of Delta. Then we'll look at the setup, why we would want to do this, when we would want to do it, and then we're going to look at exactly what we do. What are the mechanics of making this trade? Okay. Right, let's move on to the very beginning, the review. All right, so what is a call option? Call option is a contract that gives the buyer or the owner of the contract the right, but not the obligation, to buy the underlying security, which is usually a stock, at a specified price, which is called a strike price, for a certain fixed period of time until its expiration. I know that you guys have heard me explain this before. So for the writer or the seller of the call option, the contract represents an obligation. So this is something that the seller of the call option must do. There's an obligation to sell the underlying security if the option is assigned. All right, does that make sense to everybody? Anybody have questions on what a call option is? Right. Okay, we'll move on then. Let's look at what a put option is. It's basically the opposite, right? Put option is an option contract that gives the owner the right, but not the obligation, to sell the underlying stock at a specified price, at strike price, for a certain fixed period of time until its expiration. For the writer of the put option, the contract represents an obligation to buy the stock from the option owner if the option owner assigns it. All right. So I think that everybody should be pretty clear on that. If not, let me know. I just wanted to go over this, the multiplier thing really quickly. Just make sure that everybody remembers that a stock option controls 100 shares of stock. Okay, this is another important point here. So when you own a call, okay, you have rights on 100 shares of the underlying, of the stock that option is on. Okay, options are priced on a per share basis. We need to multiply the value of the option price by 100 to get the actual dollar value of the contract. So for example, an option is priced at $1, that option will cost you $100. All right. Any questions on that multiplier? I imagine not. I mean, if you've ever traded options, you already know this. So the next one we're going to get into is Delta. This is where it's important that we have understanding. So if I'm going too quick, let me know. So Delta measures the degree to which an option is exposed to shifts in price of the underlying asset. So that means, when the underlying asset, the stock, moves a certain amount, we can figure out how much it will move, or how much the option value will move, based on its delta, based on the delta of the contract. Okay. So, for example, when a call option has a delta of 0.50, and we generally call that, we just sort of shorthand that into 50 deltas. Okay. So when a call option has a delta of 0.50, also known as 50 deltas, for every $1 increase in stock price, the option price increases 50 cents. That makes sense? So, and let's say the delta on that option was 30. So it has a delta of 0.3. For every $1 increase in the stock price, the option price increases by 30 cents. I think that's pretty straightforward when you think about that. So delta is positive for call options and negative for put options. Okay. Delta can be used as a proxy for the probability of success. That's not something we're going to really look at today, but if you're looking at delta, this is something that we need to know. When an option has a 0.5 delta or a 50 delta, that option contract has a 50% or about a 50% probability of closing in the money at expiration. Okay, so it's a nice little shorthand for figuring out what are my chances of success on this contract. All right, so it's time for a little quiz, and I see I want everybody here in the watching live today. I want to see your answers in the chat, please. What is the delta of one share of stock?
Abraham se llama.
Can anybody tell me the delta?
Contestar, pero...
James, are you trying to give me your answer?
Kind of, sort of. He might not.
I think James might be talking to somebody else. So I don't see any answers in the chat yet. Aha, very good, Brandon. Thank you. So does everybody understand that concept? Everybody understand why Brandon is correct, that one share of stock has a delta of 1? Okay, Ryan says yes. Yeah, that makes sense. Yeah, Ryan says makes sense. $1 is $1. Yes. And Shills would like me to explain that. Okay. Oh, you just got here, didn't you? Or no, you've been here for a minute. Okay, so for going back on the delta, let me just back up here. There we go. Okay. So delta measures how much the option contract is going to move, given a price shift in the underlying, which is the stock, right? So when something has a delta of 1, that means for every dollar it moves, right, the underlying, or if an option contract had a delta of 1, for every dollar the stock moved, the option contract would move 1. He's got it now. Excellent. Good. Okay, we can move on. Okay, so that was our quiz. There we go. Yeah. So the answer is 1. We need to know this later. So just remember this, because it's going to come in handy later, and it'll all make more sense. It'll make a lot more sense when I show you an example later, and you actually start using that. All right. So here is the setup. Okay, so we've got this stock. We're looking at a stock here. I can't remember which one it was. I snapped this screenshot of, but you can see this had earnings, okay, after hours the other day, and you can see that it shot up on earnings. So where was it? It closed in around here at around 18.25 or so, shot all the way up to $21. So went up almost $3, and then it started pulling back. And you know that you see this kind of price action all the time, right? I believe this was a 5-minute chart on this one. So and I've seen this a million times, and this little pullback is actually not that bad. Even though this pullback is $1 or more than $1.50, $1.75, right, from the high to the low of that pullback. That's not so bad. Sometimes they will pull right back and come right into where they closed. And so if you had calls on this, let's say you had $19 calls, you would have been at the high up here. You would have been really nicely in the money, and you would have been, counting your money. You would have been like, oh, I'm gonna go out and buy myself a really nice dinner, or maybe you had a ton of call options on this. And it's like, I'm gonna go buy myself a new car, whatever it is. And then you see it starting to pull back, and you see all of your profits start to evaporate, and you know that there's nothing you can do, right? Because the options market's closed. So let's get a little deeper into this and see if there is something you can do. So we're long calls coming into the after hours earning release. Okay, I just kind of went through the whole slide without without showing these. This works. Oh, by the way, yeah, I want you to know this works with puts too. All our examples today are going to be with calls, but with puts, you just kind of do the opposite, right? And I'll touch on that in a couple of specifics later on, but just be aware that everything we're talking about here is really the mechanics of what I'm showing you is for calls, but it can just as easily be done with puts. Okay, so they had great earnings and the price jumped up, as we saw. You want to lock in that profit before the price drops, right? Maybe you see that the momentum is slowed here. You see these selling wicks on top of the candles, right? This is gonna have a hard drop. You want to lock that in. Of course you can't, right? The options market's closed. You're like screaming at yourself. This sucks. What can I do? But fear not, there is something you can do. And what we can do is we can delta hedge our position. I'm just going to, okay. We can delta hedge our position. And so, in a perfect world, right, you see this slowing momentum, you see these wicks, and you are doing this delta hedge up here. And, to be fast like this, you've probably got to be ready and do some quick math beforehand to get ready to do this, okay? So this is something when you're watching those after hour earnings, when you've got calls on a stock like this and it starts moving up, start doing that math right away. What do I have to do here to lock in my profits, before it all evaporates? I should also explain that what we're trying to do is not 100% accurate, but it's close. Okay, we can decide to lock in 100% of our profit. We can decide to lock in 10% of our profit. We just need to change the math a little bit. That's all. And you'll see how this equation works in a little bit. All right. So the way we do this is we short some stock when the momentum clearly shows that it's slowing down or it's starting to roll over. This is popped up. And you see that this isn't going up anymore. I think it's done. This is all this has got. They're going to start selling this now. I'm going to short some stock. The important thing is shorting the right amount of stock. You don't want to short too much. And you, okay, Brandon. And and maybe you don't want to short sort of not enough of it. If you want to lock in 100% of your potential profit, then you need to make sure that we short enough stock here. I also need you to keep in mind that once you do this, once you short some stock here, you're locked in. You could trade out of it again. You could always buy that stock back in the after hours. But generally, when you're shorting stocks, when you're doing this, when you're delta hedging, okay, if this stock goes up, you will not participate in those gains. It'll basically be break even from that point. You will still get the gains that you locked in, but you won't have any additional gains after that. And you'll see in the examples how that works. Okay. Now, you should also know that your short is protected by your call options. Okay, so if you own one call option we know that that call option controls 100 shares of stock, right? Then theoretically, if that had a delta of 1, and you sold 100 shares of that stock, then you're going to be perfectly even here. If you're short 100 shares of stock, if that stock goes up, you would be losing money on your short, but you'd only be losing money on that short by an amount equal to what you're making on the call that you were long. Okay, and this is why this works as a hedge. This is why you can partially hedge it. You don't have to hedge the whole thing. You can lock in some of this potential profit. Okay, so you need to decide how much profit do you want to lock in, and then we do some simple math to figure out how much stock to short. Okay, and we'll show you this simple math just in one sec. So here we go. This is it. This is the formula that you need to know. This might look complicated, but it's really not. This is the formula you need to know to figure out how much stock you've got to short. Okay, so we'll take a look and see what do all these letters represent here. Well, maybe we could just call this N pod so we can remember it easily. All right, so N is the number of shares we need to sell short, enable our delta hedge. Okay. Now, if we were trying to lock in profit on our puts, N would be the number of shares that we buy long. Okay, because obviously with puts we're expecting the share price to go down. So to cover those puts, to hedge those puts, we would have to buy some stock. Make sense? And I should have actually, before we get deeper into this equation, does anybody have any questions so far? Does this make sense to everybody? Good. Okay, Callie's got it. Don't see any other questions coming in, so we'll keep moving on. What if you can't short? Yeah, you've got to be able to short. So you've got to get your trading account set up to short, and ideally, you are trading your options in the same account that you're going to be using to short this, because then it's a wash. Then it's really not a margin issue. So the requirements, yeah. So Callie's asked, what are the requirements for being able to short? You have to have a margin account, and you have to tell them you have a certain amount of experience, that you understand the risks of having a margin account, and I believe to have a margin account, I think the amount of capital you need in your account or with whatever broker, I think that varies by broker, because I know that some people have fairly small margin accounts, so it's just something that you need to apply for. It's really not a big deal. And Callie, you've been trading long enough. I mean, you've been doing this. Well, I've known you for what, a year, 2 years, year and a half. Yeah, okay, 2020. So, yeah, I mean, they've seen that, they can see into your account. They know how long you've been trading. They're probably, when they look at it, they'll probably be surprised that you don't have a margin account yet. So yeah, shouldn't be a big deal, Callie. The one word of advice or one little warning is that when you do get a margin account, there'll be the temptation to trade on margin, to use that capital that's available to you, the new capital that you can borrow to trade against. Just be careful with that. Be responsible. If you're day trading, it's not that big a deal because you're closing out every day. If you're a swing trader or an investor using your margin, a black swan event could happen overnight. And if you're heavily margined, borrowing a lot of, a high percentage of your account value, you can get yourself into trouble that way. So if you do get a margin account, just be careful with it, be responsible, and trade safely. All right. Yeah, you're welcome, Kelly. NS has asked, hey, what's going on? Nice to see you here. So, does it work the same way for puts and buy stocks? Or does make sense to apply puts on this? Yes, actually, I guess you must have dropped in just after I said that. But let me back up real quick. Actually, no, I don't think I need to back up here. Yes, it does. It does work on puts. So for when we're hedging calls, we need to sell stock. We need to sell stock short. When we're hedging puts, we need to buy stock. So you nailed it there. You had it right. I know it's all good. It's all good. Might want to watch the first part of the recording. Well, I know you already know about puts and calls. We did a quick little bit of review, but we the first part of when we actually got into delta hedging and what is it and why and when we do use it. All right. So in this equation, N is the number of shares that we are going to sell short to hedge our calls. P is the percentage of profit you want to lock in. Okay, and we're going to use this as the percentage number. So if you want to lock in 100% of your potential profit that you've got sitting there in the market right now, your paper profit, you would put 100 into in there. Okay, it's not going to be a ratio; it's going to be the actual percentage. But don't put it in as percent; just put it in 100. Let's move on to O is the number of call options you own, or if we were doing puts, it would be the number of put options you own. So this is the number of option contracts that you own on that underlying. Okay. And then D is the delta. Now, I like to estimate the average delta between right now, wherever this is trading right now, and what I might think might happen by the open. So if this is trading at, say, $10 right now, and it has a delta of 50, but I think it's going to go down even lower. I think this thing is going to be $8 by the open. And at $8, maybe it's got a delta of 30. So our average delta there would be about 40, right? So that's what I would use in this number in this D. And this delta number, this is why this strategy is not 100% accurate at hedging perfectly, right? Because as the stock price is moving around, your delta is changing and your other Greeks are changing. So this is a sort of get it close, best fit kind of thing. Okay, so wait, how do I know the delta when the options market is closed? Okay, well, you kind of don't, right? I mean, you can't really go to the options chain. It's not going to show you an accurate delta because the options market's closed. But there are ways we can estimate it, and we can get some pretty decent accuracy on it if that's what you're after. I mean, a lot of the time you can just kind of estimate it in your head. Which I do sometimes, but it really sort of depends where the price is, and you'll see why. And depending on what this stock is doing and how quickly it's moving, will sort of determine which method you use to estimate delta here. So does everybody so far, and we'll get into examples on this, right? But does everybody so far, sort of roughly understand where we're getting with this equation? If not, go ahead and type any questions you have into the chat. But we'll move on to the next slide here, and we'll look at ways that we can estimate delta. All right. So the first way you can estimate delta is guess. Now we want to be kind of accurate. We want to have an educated guess here, right? Now, so the one of the ways that you can guess is we know that at the money options, so when it's right at the money, it's not really in the money, it's not out of the money, it's at the money. The delta on that contract should be 50 or 0.5, right? We know this. So we know that if you're just a little bit in the money, well, then the delta may be 55 or 60. If you're a little bit out of the money on a call, then your delta is going to be 45 or 40. Okay, so we can use that to guess. So if it's near the money, if it's near at the money, it's pretty easy to guess that it's going to be pretty close to 50. And pretty close is kind of good enough for what we're doing here. Okay. Another way to find the delta is to look at the options chain. Now, even though the options market is closed, most brokers will still show you all this information. You know, if I go to my broker right now and look up an option chain, I can see that all that information is still there. All the pricing information and our Greeks are all in here. I usually show more Greeks. I cut off part of this. Okay, but this is an option chain. This is from today on Apple. All right. So when I looked at this, so what we'll do is we'll check to see what the delta was before the close for options that were as deep in the money as the current stock price. So let's say I own the 167.50 strike on Apple stock. Okay, now we'll pretend they had earnings and that they are now trading at 177.50. So they've gone in the money in the after hours by $10. Okay, well, what I can do is I can look and see, okay, well, when Apple was trading at 167.50 or very near 167.50, all right, $10 in the money, the delta on that was pretty much around 94, right? Does that make sense? You see how that works? So if when it was trading at 167.50 and $10 into the money, the delta was 94, okay? If this is now trading, if my strike is, 167.50, and this is now trading at 177.50, it's gone up by 10 bucks. It's now $10 in the money. My strike is $10 in the money. Okay, well, the delta should be around 94. Make sense? So that's a quick, easy way that you can estimate it just by looking at the options chain. Okay, and you're going to, again, you'll get close. It's not going to be perfect, but you're going to get close. And then finally, there's a third method. And we can use an options calculator to find our delta. And we just have to put in a couple of numbers and it'll spit out all our Greeks. And you can see that right here near the top, there's our delta, okay? And this is for the, I did this at around the same time, within a few minutes earlier today when Apple was moving around a fair bit when I did this, but we came out pretty close to, remember on the last slide there, we saw there was 94 delta. Well, this option calculator came out to 95.5 delta or 0.955 delta, okay, for that same contract and priced at 177.50. So you can get this calculator at optionseducation.org/tools option quotes/options calculator. And I will put this link if you're watching the recording, I'll put it down in the description of the recording. I'll also throw this in the Discord channel along with the link to the recording. So you guys can go and grab this calculator. Just, bookmark this thing. Comes in really handy sometimes when you're trying to figure out some of these Greeks or trying to figure out some of the volatility and whatnot. So this is the most accurate of way of doing this, but it's not going to be 100%. We're just trying to get close, right? So we calculate the Greeks for the current after-hour stock price or the average you think the price will be. So maybe that's trading right now at 177.50, but no, it's going to continue to pull back a little bit. So I don't want to hedge to 177.50. Maybe I want to hedge to 175. So you could just type that number in there, and we'll use this calculator in an example that we're going to show you very shortly. So does anybody have any questions on any of these three methods? And we're going to keep moving along here, and I'm going to show you an example. If you have any questions, feel free to type them in. So in this example, we own two 167.50 strike calls on Apple, and Apple is now trading at 177.50. All right, so we're going to plug all these numbers into our equation. So what's n? Well, we don't know yet, right? We got to put some numbers in here. All right, so P, I want to hedge 100% of my position. Okay, so we'll put 100 in there. Oh, I should mention that, and you'll probably see this from the math, right? But we're going to use the ratio for delta. We're going to use, with the decimal point. But by using this as a percentage, like putting 100 in here, we don't have to multiply any of this by the 100 multiplier that we normally do when we're working with options. So a little bit of a shortcut. Now, so O, this is how many options contracts do we have? Well, we own two of these, right? And then there is D. So the delta we saw on a previous slide. Where did that slide go? The delta that we saw on the previous, this one here, okay? We saw that our delta was 0.955, okay? So we'll just call that 95. All right. So we'll punch that in there. So these are the numbers that we're working with in our little formula. And there we have it. So we come out with, once we punch all these numbers in, we want to hedge 100% with two calls, and our delta is 0.95. We need to short 190 shares of Apple to be 100% delta hedged on that position. Does that make sense? Everybody see how, this math is really quite simple, right? Once you've seen it run through, I think that nobody should have a problem with this. And I have often done this math in my head, while I'm trying to hedge, trying to hedge something desperately as it's moving really fast. And I'm not that great at math, so if I can do this in my head, then you guys can too. All right, let's move on a little bit here. So we need to short 190 shares of Apple, locks in our 100% our profit. Okay, so the next step in this, so that's it, we're done for tonight. Okay, when the market, we don't have to do anything until the market opens. But tomorrow, when the market opens, or when we decide that the timing is right, but I kind of suggest you do this at the market open. We need to simultaneously, now does anybody know, you may want to type in the chat what it is that we need to do when the market opens. How do we close out of this position? Not seeing anything coming into the chat, so we'll just keep moving ahead. Okay, first thing we need to do is cover our short. Okay, and I suggest covering the short first. I mean, you're essentially doing this simultaneously. You're putting in one order, then the next, right? And maybe you want to wait until the short order fills until you put in the next order, okay? Because we don't want to be naked short, all right? Even, I mean, it's not, when the market's open and everything's cruising along, 99.9999% of the time, everything's going to be fine with you being naked short for 30 seconds or a minute or two. It's not a big deal, but there's that 1 in a million black swan that could come along, and being short could cause some serious, having a naked short could cause some serious damage. So ideally, if we can avoid it, let's not be naked short. Okay. And then the next step is we sell our calls. So once we've covered our short, then we're going to sell our calls. And we're out of the trade. We're closed. All right. And it all should just be a wash at that point. We've basically, we've already locked in our profit. We knew last night how much we were going to make today. And it may have changed a little bit. And like I said, because it's just not going to be 100% accurate because, the market is still moving around. But we managed to lock that in. All right. So why does this work? Okay. For every $1 that Apple goes down, our calls will lose $190, right? Because each call is controlling 190, or is controlling, oh yeah, we got two calls, right? So yeah, for each dollar that Apple goes down, we got two calls. So on our two calls, we lose $190 in total, because each of those calls is going to lose $95 because it is a 95 delta. Okay. But our short, right? Remember, we're short 190 shares. Apple goes down $1, we gain $190. So we've completely offset the losses in our calls. That makes sense? Now, for every dollar that Apple goes up, our calls will gain $190. Remember, we've got two of them at a 95 delta. So that's $190 that will be the total value increase of our calls. But our short is going to lose. We're short 190 shares. It goes up $1, we lose $190. It's a total wash. Now it'll be a total wash until the Greeks start moving around. Okay, remember, this isn't perfectly accurate. There's going to be a little bit of variation in here, and the more the stock price moves, the more variation there's going to be. So as the price changes, the Greeks change, and by the Greeks, I mean Delta and Vega and Gamma. But the one that we're most concerned with here is Delta. Okay, so as price changes, our Delta is going to change. Our level of Delta hedging would need to change to keep pace. Okay. Now, there's no reason why you can't sit there and watch this and constantly adjust your position to keep your Delta hedge neutral. Okay, to keep it so that for every dollar, every dollar you lose on your short, you gain $1 on your calls. You can sit there and do that by adjusting the size of that short position, but it's a lot of work. And I really don't think it's at this point, I don't think it's necessary unless you have an incredibly large position that you're trying to protect. So was somebody had a question? Oh, it's sorry, it's my not talking to me. Okay. All right. Let's move on. All right, so let's look at a live example here. Now, before the close, I bought, I found a little kind of YOLO stock. So this is Shills. This is called Delta Hedging. Is there gamma risk? Yes, there is gamma risk. And I was sort of talking about how, but there isn't much gamma risk, because you're only in this overnight. You're going to be getting out of this position in the morning, and you can wake up in the morning and adjust it if you wanted to. But it's not the kind of gamma risk that you're thinking of, like with the GameStops and stuff. I guess if that sort of move happened, then yes, there would be a little gamma risk. But this is the stock market. Nothing comes for free, right? And that's why maybe you don't want to necessarily try and hedge 100% of your gain. Maybe you want to play a little safer, only hedge 50% of your gain. And that will eliminate a lot of that gamma risk. And the gamma risk really only comes in when you're trying to risk 100%. That makes sense? Okay, so good. All right, so we are going to look at a live example. Whoops, that's not there yet. Okay, yeah, where was I? So before the close, I bought this. I bought one call in this this stock. It's got really high short interest. I think it's close to 30%, and it has earnings, and those earnings are supposed to come out at 540. Oh, look, that was like 3 minutes ago. So let's take a look and see if this is open. So anyway, here, I'll show you this. I'll show you what I bought first, okay? So I bought, so the ticker is VLTA. This is Volta. It's some sort of, I think it might be something to do with electric EVs. All right, so I bought the $3 call, paid 25 cents for it. So I got it at the midpoint here for 25 cents. So I've got 25 bucks, all of $25 into this. And I did this so that, I'd have some skin in the game here for where we're going next with this, okay? And the delta on that at the close was 40. All right, so we'll take a look. Hey, Anis, I'll get to your question right away. I just want to pop over to the chart and see if earnings actually came out on this thing. So we'll just bring up my intraday chart here, and it looks like, seeing a ton of volumes, it looks like earnings might have come out. I mean, this is continue to go up after hours. And remember, I have the $3 call, right? So it's not even in the money yet. Let me go over to my news platform and see if I get anything. Nothing. I'm not getting anything on my news platform. Okay. We'll look over here on Earnings Whisper maybe and see if we see anything. And they aren't showing anything yet either. Okay. Well, it's kind of hard to say if this actually, if earnings have actually come out on this yet or not. But we can still play around with this one, and maybe we'll look for some other ones. Actually, if anybody knows any stocks that moved a lot after hours, we could go and look at those as an example as well. And it doesn't matter if they went up or down.
It was Rivian.
Oh, that's right. Yeah, Rivian. When I looked at it earlier, it was just flopping around. It was both going up and down. But yeah, maybe we'll get to that one in a sec. We'll finish up here with Volta, and I'll ask, or we'll take a look at NS's question right now as well. So NS says or asks, so a practical scenario to use this is if your call is already in profit and you want to lock in the profits before a significant event like earnings or CPI release. I think you're understanding that wrong. And because you kind of missed the beginning of this, what we can do is we'll go back to the slide that's all of this is gonna make sense. Or the answer to your question will make sense when we go back to this slide way back here. Yeah, here we go. Wait. Yeah, this one. Okay. So yeah, so when we're wanting to use this, when this is most useful, in my opinion, is your long calls coming into earnings. Okay, and they have earnings after hours. You're watching after hours, and you see the shoot up. You get a slowing momentum. You see selling wicks on top of these candles. You know this is going to roll over. You're like, get me out of here. Right up in this area is where I want to be shorting the stock and locking in my profit. Because, this is, of course, if I'm convinced that this is coming back down, which you see happens so often, right? I can lock in my profit at, say, this 2075 area here. And in my example, when we were talking about this, we said, well, maybe we've got the $19 strike. So, from the 19 to the 2075, that's like, that's a $1.75 or $175 per contract that we would be locking in by selling some stock right up here. So does that answer your question, NS? It's for it's most useful for locking in profits when the option market is closed. Because if the option market was open, well, you would just go into the option market and sell your options there. But when the options market's closed, like after 4 o'clock, and until 9:30 the next morning, because you could also do this in the pre-market, right? You just can't get there. You've got no way of getting out of these options. So this is a way to enable you to lock those profits in. All right, so let's pretend here. Okay, going back to my Volta example. All right, let's take a look and see what the delta would be, given the current stock price. All right, so we could guess. This is a little closer to the so at the close, our delta was 40. Okay, so let's take a look at where this is at now, and I see this is now pulling back. Okay, so in a perfect world, I would have hedged this right here, right up in here. This isn't the best example. It's not trading a ton in the after hours, but it is trading a little bit here. So let's pretend we were going to hedge this. WYNN. Let's pretend we were going to hedge this at say 270. Okay. Now, what do you think the delta is going to be at 270? We closed in here at 260. Okay, and when we closed, that delta was 40. Now that we're up at 270, we're closer to the money, but we're not in the money yet. Anybody want to take a guess at what the delta might be? NS is asked, so the short is at the open the next day. No, the short is like right now in the after hours. When this has earnings, let's go back to this slide. Okay, so this stock here had earnings right after, say this is like 4:05. We've got a 5-minute chart here, right? So at 4:05 they had earnings, they shot up, okay, and then they started flopping around a little bit. Well, that's when we want to short the stock. At 4:10 or 4:15 here, that's when we're shorting. As soon as we decide that, okay, this isn't going to go up any farther, I want to lock my profit in, that's when you short it. Okay. And Shills has asked, can you short stock after hours and pre-market? Yes, you can. You have to have a margin account to be able to do that. I'm not sure if you were here when I was talking to Callie about that. Callie had asked some questions in the chat about having a margin account. Yeah, as long as you've got a margin account, you can short stock after hours and in the pre-market. You can't use market orders to do it, though. You've got to use limit orders, which you should be using anyway. Nobody should really be using market orders. Okay. Let's see. Where was I? Oh yeah, we're trying to figure out the delta on this guy. All right. So nobody wanted to guess what the delta is. I'm going to guess that the delta, with that stock having gone to 270, I'm going to guess that the delta was going to be 43. All right. So we'll use our little calculator in a minute, and to actually calculate that. But my guess is 43, and if anybody else wants to type in a guess, you're more than welcome to. So we can. Let me bring this in. So here is a live. Actually, I don't need that. That's what I'm looking for. All right. So this is the options calculator that I showed you earlier. And we are going to check and see what the delta on this should be when Volta was at 270, right? Remember, 270 is where we figured we would probably short that stock to lock in our profit. Okay, so the delta, oh, that's odd. Oh, that's why. Okay, I have the September. I wanted to buy myself more time. Okay, so I've got the September contract on that. And 270 is what we're looking. Oh, look at that. Okay, so we can see here the delta, okay, is at 0.4383. So about 44 is the delta on that when that stock was at 240. All right, so does anybody want to tell me I have one contract, I want to hedge 100%. I'm giving you really easy numbers here so that you can do it in your head, okay? I want to hedge 100% of my position in that, okay, at with one contract and a delta of, we'll call it 44. How many shares do I need to short to hedge that position? Can anybody tell me? So I bring up the I'll bring the formula back up here. Go. I don't see anybody typing any numbers in yet. So remember, I want to hedge 100% of my position. That's P. I got one contract. That's O. Our delta is 44. How many shares do I need to short? What is N in this situation? NS. No, not correct. Ryan's has got it right. 44. So I need to short 44 shares, and I will be delta hedged at that current price, at that price of 270. Okay. Now that's going to change a little bit. If the stock kind of flops around. All right. I think we should do another example. What were we going to look at? Oh yeah, we're going to look at Rivian and see what's going on there. So yeah, up, down, up, down. This is crazy. Well, this kind of gives us two examples. We can do a put example here, and we can do a call example as well. All right. So let's start with the call example, okay? And let's say we were smart enough to, we were good enough, smart enough. We're going to try and lock that in at say 40. And yeah, Callie, I mean, anybody who's bought calls, and so not only are they going to get, their calls are just not working. They're going to get volatility crushed as well. So it's really not going to be working for them. And this is another thing that can actually be really helpful to us is, helping us to avoid that volatility crush by locking this in the night before, right? And that volatility crush, once we've locked in, this is something I forgot to mention in any of the slides, but once we've locked in, that volatility crush can work in our favor. Okay. As long as we calculate our deltas correctly. All right. So let's bring up an option chain for Rivian. Bring this in here. Oops, wrong one. Here we go. Okay, so this will show us everything that was sort of going on at the close. So let's look at the monthlies on this one. So let's say we had at the money. What did we close at? So 38. So the at the money is the 38. We could have had that for, let's call it 340. So let's say right at the close, we bought a call for $3.40. Okay. Now, let's come back over here. Let's look at this pricing. Okay. So yeah, let's say when it went up to 40 here, that's when we decided we want to lock some profit in. So that was basically $1 above where we closed. I thought it said 38 it closed at. Let's go back over to this. Yeah. This is 38 now. Oh yeah, I forgot that. It's live. Nothing else on the page does. Okay, so actually our Oh, this is updating live in a way. It's not updating price properly. All right. So it's telling us that the delta on that is 58. I don't think that's correct. I want to go and check my little options calculator here. All right. So we have the this one, our strike. What did we say our strike? I don't think we said what our strike was. Let's just say our strike was 39. And we wanted to lock this in when the price of the stock got to 40. Okay, so that's a 59 delta. So by now you should know that if we had one call and we were gonna lock in 100% of that at a 59 delta, we are gonna short 59 shares, right? And that'll lock in or should lock in our $1 profit on there. All right, what if we had puts? Let's go take a look at what we could do with puts here. So when this earnings came out, this dropped quite a bit. And if you owned puts on this, once it came down here and it started flopping around, started putting this big green candle, then maybe you would decide that you want to lock those puts in. Maybe you got lucky and were able to lock them in here at 37. Okay, so to do that, let's just bring up our little option calculator again. Okay, so and let's just say that our strike, again, let's say we use the same strike, 39, okay, which was that closing price. That'll be our strike on the puts. And this time we are going to change the stock price here that we're calculating for. We're going to change that to 37. Calculate that. Okay. So you can see here, now on the put side, you can see how this, we've got the call side here and the put side. See on the put side, it says our delta is negative 52, negative 0.5227. All right, so about 52 deltas. So we will need to buy, to lock that in, we will need to buy 52 shares of Rivian, and that'll lock us in with that $2 profit. Does that make sense? Excellent. Let's just, for fun, take another quick look at this thing and see if anything has changed here. Nope, nothing has changed. Okay. All right, let's go back over here. Just trying to find out where we are now in the presentation. There we go. All right. Hopefully that makes sense to everybody. If you guys, if you have any questions, if you're here with us now and you have any questions, feel free to type them in the chat, or you can unmute and ask your questions. If you want to do more examples, we can look at some more examples. If there's any other stocks you can see that may have moved a bunch in the after hours that we can look at, totally happy to do that. Yeah, if there's any more questions, this is a great time. If you're watching the recording, you can always shoot me a message, tag me in the options channel, ask your question in there, or if you want, you can DM me. Yeah, if you think you're going to be doing this, if you're playing calls or puts on anything that's got earnings coming up, and you think this is something you might want to do, but you're not quite sure, we can run through a couple of what if scenarios with you in one of the Discord channels, and say, okay, this is trading at 50 right now. What if it jumps up to 55? What do I got to do to lock in there? I'm totally happy to help you out with that. But I'm not seeing any more questions coming in, so hopefully everybody's got a really good understanding of what we're doing here. I think if there aren't any questions, I think we'll move on to should we consider IV? Um, yeah, I mean, you need to be aware that IV is going to drop a lot in the morning. It usually doesn't drop that much, like right at the open. It's usually fairly stable for the first 5 or 10 minutes, and then really starts dropping off. Especially if the stock has made a good, a big move as well, right? But what's likely to happen in this situation, or the best case scenario for you, if you've hedged it, we'll just go back to, we'll go back to one of these examples. Look at one of these stocks. Probably not this one, but look at Rivian here. Okay. Let's say we had hedged these puts down here at 37, right? Well, once you're hedged, you don't really care where it goes, but the easiest way to deal with everything is if this goes back up to right where it closed. Because then everything is just totally a wash, right? And you don't really have to think about much, and you don't feel bad about having hedged. What you don't want to see happen here, if this had come down and you hedged at 37, because it was going up a little bit, and then this rolled right over, and it ends up opening at 30. You're not going to be thrilled about having hedged, right? But you can, if you're watching it, you can always undo that hedge if you want to. We talked about that earlier. I don't think that's the best idea. I think once you commit to it, you should just be committed to it. You are locking in profit. You're not going to lose that profit that you locked in, unless so you get into a gamma situation that goes against you. But again, maybe don't try and lock in 100% of your profit. That makes the math a lot easier. But it doesn't give you any wiggle room, right? But trying to lock in most of your profit is probably the better way to go. Because there will be occasionally there'll be gamma situations, and there will be occasionally IV situations. And if the thing is really moving, then that's when those things will be at its worst. But a lot of these stocks, and you can see this in Rivian, right? They flop around like this. It makes big moves. They don't normally actually make big, or they don't always make big moves in both directions. But we can see here that we've got big moves in each direction, and then we're settling in now in around 38. And I suspect that this, will continue to continue to trade in sort of 38-ish area, and probably open, or at least the pre-market will probably open in that area as well. And we might see some more movement in the pre-market. But what probably happened here in Rivian is they had their earnings released, the report released, it dumped, and then this move up, maybe this is on the conference call. Or maybe not, right? This does look like a conference call sort of reaction to me. Or it's quite possible that this move down was just the wrong reaction. Everybody decided to buy this up. Maybe the conference call started up here where it started coming down. I'm not sure. I mean, we could look and see what time that call started. But I suspect actually, the first one, that the call started about 20 minutes after they released their earnings. And they started the call out by saying some good stuff. And some people started buying it up. That's probably what happened there. So these are all things that you have to consider, that come into play. And yeah, Kelly says the first move is always the fake move, and that is so often true, Kelly. Yeah, maybe not always, but I mean, you see that a ton. And you see that, it's too bad we don't have any companies bigger than Rivian. I wish I had done this a week earlier, because we would have had a pick of all sorts of earnings to take a look at. There was one more. There was another one that I was looking at that might have moved. CN. This one might have moved a bunch. Yeah, okay, it did. So you can see this. I mean, this has had quite a move. This has moved, down here, almost down to 90, from 120 to 90. Percentage wise, that's a great big move, right? and then it popped right back up again. So this one here is the perfect example of, if you had, if you had puts and you had locked your profit in down here, when this thing starts shooting back up to here again, you're pretty happy that you locked in down here, right? So these are the kind of situations that that this strategy works best for. So, if you're playing earnings, you're probably watching these things after hours. I'll get to that in one sec. Where was I? If you're playing your earnings a lot, you're watching these things after hours. You've seen these moves that these make, and you probably have a good understanding of when you want to lock it in, because you've kind of smacked yourself in the head sometimes when you've seen it make a big move, and then completely reverse that move and be right back where it started again by the open. So NS is asking. Yeah, actually, that's a good point. Okay. So Ennis has asked, I understand SPY is expensive, but logically this would work on SPY too. And theoretically, yes. But what is the event? Is there an event that makes SPY move so much that that you would want to lock in on it? And then NS says, actually, wrong questions. I guess since SPY trades for 15 minutes after hours. And yes, there are actually a number of stocks that trade extended hours, usually an extra 15 or possibly 30 minutes into the after hours. That doesn't always cover you for these options plays, though. But they are usually the large cap stocks that have extended hours for options trading. But it's not very long, 15 minutes to 30 minutes. Kelly says, this definitely makes sense playing earnings release, less of a gamble, because that's basically what we're doing when we're playing earnings releases after hours. Well, certainly, you're taking out one of the factors that can really, that can go wrong for you, and often does go wrong. Earnings, playing earnings is still a gamble, and I think you'll find that most people, most traders have been doing this for a long time, won't touch earnings anymore. I do it occasionally, and we looked at some of the strategies that I like to do that are very risk defined. Like we looked at that smarter YOLO strategy, stuff that's super risk defined. Or if I think that the risk reward ratio is just skewed so far in my favor on an options play, that's when I'll take an options play for earnings. But generally, I don't play them. But I know lots of people do. And lots of people like the YOLOs. So this is something that you can do. If you're going to be playing those YOLOs, you should have some tools in your toolbox to help you maximize your profit on those trades. And this is definitely one of those tools. So yeah, great point, Kelly. Does anybody have anything else they want to, any questions they want to ask or go over? All right. Here. And let's take a look at what we've got coming up. So, obviously on Sundays, I'll be releasing videos, market update. On Thursday, coming up next Thursday, a week from today, we have Ticker Talk again. And I'm going to start doing a quick little market update. A very short version of what I do on the weekend. We're going to start doing that at the beginning of every Ticker Talk because a couple of people have asked for that. And eventually we're going to be moving the Ticker Talk into Wednesday. That will be starting in September. And I'm also thinking about making it later in the day. I'm gonna put a poll out on the Discord and see if you guys want to do these Thursday sessions later in the day. I know for anybody who's back east, it's 5 o'clock. Maybe if maybe you're just getting off work at that time, or maybe you're on your way home. But 5 o'clock is probably a little early for a lot of people. So I was thinking we could do it 6 Eastern, 7 Eastern, even 8 Eastern. I wouldn't want to do it any later than 8 Eastern. But yeah, I'll send out a poll and see what you guys think about that. So I think that is it. This is a good session. I hope you guys enjoyed this. I enjoyed it. Lots of good questions today. And hopefully this is something that you can just kind of, put in your toolbox and pull out when you really need it. Because it's pretty easy to do and can help you to maximize those profits. So thanks everybody for coming out, and we'll see you all in the Discord.